Ladies and gentlemen, good morning. Wow, what an exciting week we've had, especially in the interest rates, which are the drivers of all things. Now, this is a weekly chart of the 5-year yield in the US. As you can see, it's approaching the very, very important level of 180, 187, which is this line here. 187%. If we get a closing above that line, all kind of hell is going to break loose. Let's have a look at what the 10-year note did in terms of yield, and exactly as we forecast, it arrived in the area between 233 and 237, which we thought it would hit very quickly, and it has. Risk reward at this level is to be square or to be long of volatility, because it could easily either continue straight through or it could come back down all the way down to 210, 215, which is our favorite it is our favorite scenario. If it comes back to these levels, it's a very good long risk reward for an eventual break of these levels and a test of the 250 level in the 10-year note. The 30-year note actually is doing nothing, and this is a weekly chart of the 30-year note. It has basically closed where it opened, and that is actually telling us that the yield curve is saying that we are unlikely to have much higher rates around than the 3% area where it is at the moment. So the yield curve is pivoting around the 30-year note, which is at 3%. If that now starts breaking the downtrend lines, and these are very long-term downtrend lines which have been in place for approximately 20 years, we could see very, very sharp spikes up to 340 or even 4%. So we are at very, very pivotal levels in the US interest rates. We would recommend here being long of volatility, and because even if the market comes back now towards the below the 3%, we are sure that it has another wave in it at some stage which takes it back up towards the 350 area. It's a very unstable top in 30-year notes, in 10-year notes, and also in 5-year notes. You can see how this level in 5-year notes has caught it for many, many years, all the way since basically 2013. If we break this area of consolidation, we could have a massive move, but at the moment we just don't see fundamentally what's going to cause it. It's not as if we have roaring inflation in the States or that we have roaring growth. We just have a better perception of future growth, and we would have thought a few weeks of consolidation around this area is actually going to be very bullish longer term. So that is what we would be betting on at the moment. What is happening to Europe? Well, this is a chart of the Schatz, the 2-year note, and this is a chart of the Bund. As you can see, after Draghi's comments on Friday, the 2-year note just went ballistic to the upside, basically saying there is no chance that Draghi is going to tighten anytime soon, or even announce the end of QE. QE will go on for probably many more years. And as you can see, the Schatz, when it was trading last at these levels, the Bund was trading 165, and it's now trading just below 161. So immense steepening of the yield curve. Any steepening of the yield curve by itself suggests that there is an anchor, and the anchor seems to be in the 2-year note, which is in fact doing nothing. And this suggests to us that we are at a very, very unstable level, which, coupled with the charts we will show you next, tells you that volatility in the bunds is about to explode. In fact, all the charts that we look at suggest the volatility is about to explode. So we would not be surprised in the slightest now to see the bund trade all the way back up to 164, 164 and a half, 165. We are building up to the biggest dangers that we have for the foreseeable future, and that is the biggest macro dangers, that is, and that is the Italian referendum, and not anymore the Fed meeting in December, but the ECB meeting in December. We could have complete and utter fireworks on those two occurrences. Don't forget that the Bund has this intrinsic call option on Deutschmarks, and we could see something quite amazing in the few weeks ahead before year end. We don't know what's going to spark it. We just see what the yield curve is doing, and the yield curve is telling us in no way to be short of volatility, because things could get really, really complicated. We could have a scenario that the Bund goes all the way back up to 165 and then collapses. That is quite likely at the moment. So now let us see the next chart, which is the weekly yield chart in bunds, and that will make things much clearer. Well, here we have a long-term weekly chart of bund yields. As you can see, this trend line has caught it since 2011, and last week we tried to break it, but we put in a close at the lows of yields, which tells us that there is a potential reversal coming. We would not be surprised now by whatever it is that Draghi does, or the market anticipates that Draghi does, that we come all the way back down to zero, which would be around the 166 area, and then we spike tremendously all the way up to 1%. Now that is huge volatility that is going to be coming to the bunds, and therefore we will be looking for sure to get long of volatility. Well, the massive changes in yield curves over the past week have had their biggest effect on what you would expect to have the biggest effect, and that is the value of the euro against the dollar. You can see that every day since the election of Trump, we've had a higher dollar and a weaker euro. We are now approaching, we're very close to the lows below 105, which we made in 2015, and the market is very, very stretched. That doesn't mean very much when we have such a powerful trend, but it just gives us an idea that we are at very unstable levels. We could have a complete reversal and a move back up to 111, 112, which is unlikely, or we could have, which is 700 points, or we could have a breakdown eventually, which will drive it all the way below parity. That is why we are saying volatility is going to absolutely explode in fixed income and in foreign exchange. The same can be seen in the dollar index. This move at the moment is so powerful that it's very hard to fight. The calls are for 105, 107 on a break of this, which we've had. So we would not be surprised to see at least this whole move on top of this level. And since this is a move from, call it par, down to 92 or 93, that's 7%. So we will be looking for another 7% on top of par. So we're looking for at least 107 in terms of the DX. So we are looking for a move which takes the euro well below par. These are massive adjustments, and volatility is bound to explode. The same picture is painted by gold, which we would not be surprised at all if it fell even in the next couple of days to around the 1172 level before it made any kind of bounce. But it looks to us like there is a definite downtrend in place in gold now, and we will be trading it rather than positioning for the very, very long term. We like gold around these kind of levels for the longer term, but these will be trades setting up into what could be even new lows in gold. We would not be surprised to see new lows in gold. Tell us about equities. Well, funnily enough, we think that equities in the States are going to be relatively quiet. We think the volatility that was in equities is actually being now transferred to interest rates, fixed income, and to the currencies. Currencies are going to be very exciting over the next few weeks, while we think equities are going to be very boring over the next few weeks. We certainly have moved space to go above 2200, maybe to 2220, 2230, but we think that that is about it. That is a, another 2-3% on the upside, and that's all we can possibly see. Unlike in TF, which is basically setting itself up for some kind of a moonshot. We would not exclude a move back down to 1262 and then a complete moonshot into year end, taking it well above the 1350, 1450, even 1500 level. So we're talking about a 5 to 6% move higher from these levels even after a retracement. Our favorite vehicle for any longs in equities in the US has to be the Russell 2000. Now, what is really actually quite exciting is that the DAX, we feel, is setting up for something which we haven't seen for a long time, and that is a break of these levels which have capped it, the 10,800 level. If you think about it, if EU interest rates will remain low for a protracted period of time, and the Bund goes back to zero over the next few weeks, we could have and coupled with a breakdown in the euro, we could have a complete moonshot in the DAX. We would not be surprised if we found this kind of behavior over the next few weeks. Volatility in DAX is definitely to be bought against volatility in the ES. We think the moves in DAX are going to be much, much more exaggerated than the moves in ES. We would not be surprised to see a 12,000 trade before the end of this year. That is a big move, and much, much bigger than you're going to get in the ES. So we are buyers of volatility in the DAX against sellers of volatility in the ES. We think that the DAX is going to be much more rewarding in terms of upside than the ES. Coupled with the currency factor, coupled with the interest rate factor, we think that this is probably one of the highest, best risk-reward trades. long volatility in the DAX, and short volatility in the ES. The fundamental picture actually makes us even more certain that ES is going to do very little for the next few weeks, very little relative to other markets. We have the 17 times Blue Angel, which has caught the market perfectly for many years, coming in around the 2220, 2230 area. We don't see this level being broken anytime soon, especially when we look at the sectors. Which sector is likely to keep on going up to carry the index much further than that? Consumer discretionary is unlikely to break the top of its trading range by very much in the foreseeable future. There is no reason for it to do that. Consumer staples will definitely not do it while the bonds are reversing. Energy by itself certainly can't do it. The financials have already nearly reached the 14 times expected earnings, which has caught it very well for, well, just about forever. So we are unlikely to see XLF much more than, let's call it 3-4% higher, which would reflect in that 1-3% range that we are talking about in the index. The healthcare stocks, yes, well, they might rally a bit, but certainly cannot take it much higher. And the industrials are our least favored sector. The industrials are already reaching extremely overbought levels. We just can't see the industrials being the powerhouse that they need to be to take the ES much higher than the 2220, 2230 level in the foreseeable future. The other sectors, XLK, well, yes, that could keep on going. That is the only sector that we like fundamentally, but still by itself it's unlikely to add much more than 2 or 3 percentage points on the ES index. Materials have already, we feel, discounted a hell of a lot, even, you know, building the damn wall. So we are unlikely to see much support from materials, and in any case they're a very small weighting in the S&P. So telecommunications, again, small weighting. Yes, can they rally? Absolutely. We like this fundamentally as a sector, but everything that we look at, including utilities, tells us that the rally in ES into year end can be in the range of 2 to 3 percentage points from where we closed on Friday, while the move in the DAX can be much greater, approaching 10%. So we those would be our recommendations for you. Let's open those up. Bunds, we need to be long of long-term volatility at this crucial juncture, because as we showed you, we think that bunds could now collapse by close on 30 basis points and then go absolutely ballistic on the upside by 100. This would be volatility last seen in the bunds around 2 years ago. And volatility at the moment is certainly not at levels which reflect that kind of move over the course of the next few weeks. ES, tough to see it much above new all-time highs, and Russell 2000 is definitely the preferred instrument for longs, as it's the least affected by the strong dollar and most exposed to the domestic economy. TLT, we think it will rally and it will fail around the 127.50 area and then possibly go much higher. And the US dollar, you have to be longer volatility because this is such an unstable level around 105. We could easily go all the way back to 112 on a surprise, or collapse to new lows, in which case the targets become somewhere around the 92 to 95 area in the euro, which will take the US dollar at least to 107 in the DX. So volatility. Buying straddles at these levels, we think, is a very smart play, and then we can get rid of whichever leg is not working. So those are recommendations for you for next week. We will be with you and tweeting what we're doing all the while through. Thank you very much indeed, and have a very profitable week.